The money behind the moves. I'm House Hunter Hicks, here today with Louis Capelli with One Lending.
Appreciate you having me, brother. Beautiful listing you have here in Sedona.
Thanks, man. We're out here at one of my listings at 50 Crystal Sky Drive today, down in Sedona, Arizona. Well, let's start with why financing even matters, especially in terms of speed. You know, we do a lot of work in Flagstaff and Sedona, and we have very seasonal markets, and I think we have very hot markets. So why does speed matter in terms of financing?
You never know when the perfect opportunity is going to come up. And I always tell clients, like, if you can get the financing dialed early, it's going to create a better experience for you because we don't know what we're going to uncover. You could have a layup of a deal, A+ credit, you're on a W-2, really easy to underwrite, and there's no issues, right? And that's great and gives confidence as you begin your shopping process. But maybe you're self-employed, or maybe there's some nuances on the credit or things that we need to address. If we have time to address those, we can ensure you have a much better experience, and also that you can act quickly and make an offer if the perfect home becomes available. And so when we start that process up front, we've uncovered all the potential challenges and pitfalls. We can be quick to act when something comes to market that fits your needs.
Yeah, that's really good. And you know, on my end of things, the number one issue I've seen is when we look at homes too early or before we have that financing piece dialed in, we find the perfect home, and then, you know, we find the medical debt that hasn't been paid off over the last 3 years, or someone doesn't qualify for a loan or they can't afford the dream home.
Absolutely, yeah. I mean, we don't want to waste your time, your money as a client, right? You're out there spending your time looking at homes. Maybe you're paying for home inspections if you get under contract and appraisal. Last thing we want to do is tell you, hey, you don't qualify, and now you've got sunken costs in this process. The other thing that's really important to keep in mind is the budget. So it's really easy to fall in love with a home. That's the exciting part. You go out, everything's becoming real, and then you talk to a lender and find out this is way outside of my budget. So having the numbers dialed is critical, because as clients begin shopping with you for homes, we want to make sure we're looking for homes that are within the price range that kind of meets their lifestyle and their needs. And so outside of just getting approved for a loan, we got to make sure that the loan is customized to the client's actual budget and that they feel comfortable once they actually get under contract.
What about, you know, we talk about shopping for homes. What about shopping for the rate early too?
It's a great question. I think when shopping for a rate, you got to be working with somebody that has access to multiple lenders. Every bank has a different rate stack, and every scenario is different when it comes to the financing. And certain banks like certain types of loans. We've got investors that really love VA, FHA, government loans, right? USDA, for example, and they have better pricing when it comes to those products. There's certain lenders that love jumbo loans, and they specialize in those, and they've got great rate sheets for those. And then you've got your bread and butter conventional stuff, and there's lenders that excel there. So working with somebody that has access to multiple banks can oftentimes give you a better deal, because you're able to find the lender that meets your specific scenario and gets you the best possible deal for your loan.
And to clarify a little bit more, so you're a mortgage broker.
That's
when
right.
you're talking about the lenders, you're going to these banks to try and find the best rate for that person's scenario and whatever product we're looking for, right?
That's exactly right. Yeah, we have this system called Loan Sifter, and it basically pulls up for every given scenario the different rate stacks for that client and all the banks that are offering best pricing based upon that specific day in the market. And so my job as a lender is to look for that best rate for the client, but also to know the scenario. So while there may be a bank that has the absolute lowest rate, and it might be the best deal for the client in terms of the financing, we also have to understand the client's situation and their financing. So if you've got a really complex deal, it might make sense to not go with the absolute lowest rate, because we're trying to just get your deal across the finish line, and we know that certain banks might be a little bit more flexible with unique income scenarios or unique credit scenarios. So we're keeping all of that in mind when we pick the financing, but in the end, having access to multiple banks allows competition, and I'm not tied to one bank's rate stack. That makes me more competitive and allows us to get better rates for our clients.
Got it. And you know, if you are looking for a home in Flagstaff and Sedona, how worried should we even be about the rate if we're going for financing?
I think the rates, it's an important question, but there's other factors that matter. And one of the things that I tell clients that are shopping in this market right now is that while the rate may be higher than we've seen during kind of the COVID lows, there's wins to be had as a buyer in this market. And specifically, it centers around the acquisition cost of the property. So COVID, you might have been spending $50,000, $100,000 over asking just to win a deal because there was multiple offers. in this market, you have an ability to maybe get an offer accepted under asking. You might be able to get concessions paid by the seller to cover your closing costs. You might get a new roof or other repairs done that you might have not have been able to negotiate if you were in a multiple offer situation. So while the rate matters, I also think the deal matters more, and we have to have a kind of a candid conversation about how the rate can impact a financing deal, but also how we can get other wins for buyers to help make their financing more attractive to them.
I think that makes a lot of sense. I remember back in 2021, it was near impossible for a first-time home buyer to even get in a house because they couldn't afford to outbid somebody who had cash or had funds on hand to purchase above an appraisal. So, seeing now that rates have lowered now from 8%, and we are getting people pre-qualified financing done, and there's more inventory on the market, we're seeing some of these deals start to come together where we can get closing costs paid for, and we can get repairs done, or we can even negotiate on the price.
Absolutely. Yeah, I mean, 22 was a really kind of unique time. Like, I had so many well-qualified clients that would submit an offer. There was 10 or 15 offers on a house, and they wouldn't even get a response back. These are people that have excellent credit, money saved for a down payment. On paper, they should have been able to win a deal, but they weren't because of all this competition. And so I had a lot of clients postpone their search and end up buying in 23, 24 when the rate situation was not as favorable. But like I mentioned before, like, they got wins, they got repairs, they got concessions, and then we become creative as lenders, right? So how do we use concessions to do a temporary buy down? How do we strategically position folks to refinance when rates dip? And you're absolutely right. Rates are now in that low 6 range for a lot of scenarios. Some are even in the mid to high 5s, depending upon the type of loan program we're doing. And everybody that bought in 23 when rates were cresting near 8%, those guys have had an opportunity to refinance and redo their deal and get some relief on the payment. Then that's the beauty of a refinance, right? You're going to have an opportunity at some point, we don't know when, but to redo that loan. And you've captured for that client perhaps more equity in their home because they didn't overpay. They were able to structure the deal in a way for them to get the wins, and then they get to redo the mortgage on the back end when rates end up dipping. And that's one thing that we do as brokers for our clients. Like, we're always looking for refinance opportunities for people. So we take on the burden of watching the market, looking for those opportunities and reaching out for people when the opportunity presents itself.
So how can we together look for those refinance opportunities and coach our clients on those refinance opportunities as we start to see buyers be able to get essentially better deals or get closing costs paid for? How can we coach them through, hey, you're getting a 7% rate right now. What does a refinance look like?
It's a great question. So, like, let's say a client closes on a home. We've had that conversation about what a refinance could look like for them down the road. I think for folks like ourselves that are in the market, we're constantly doing deals. We have a stronger pulse on what the market is doing in terms of rates than the average consumer does. Mm-hmm. So little things like just picking up the phone and checking in with your client and saying, hey, did you notice that rates dipped? Have you talked to your lender? I have a couple partners that I work with that were dropping off closing gifts or kind of holiday gifts at the end of the year. And they had that conversation with clients. Did you know that rates have come down? And we've had a lot of folks reach out for refinances because rates have dipped in the fourth quarter. So I think just kind of having a conversation with folks and looking out for them and making that phone call, because while it may seem intuitive for us, it may not be for the consumer. They're out there doing their thing. This is not their number one focus, which is the market. We can do that as people in real estate and professionals in real estate to kind of look out for our clients and have those conversations. The other thing that I tell people is, like, take care of your financials as we kind of prepare ourselves for a refinance down the road. What does that mean? So if you're self-employed and if your strategy, for example, is writing off income every year, let's talk about how that might impact you if you're looking to refinance down the road. You might have claimed enough income in 2024 to buy the house, but if you write everything off in 25, we might not have a chance to refinance. So just giving people some insight on how their financing could evolve as they're waiting for that moment is also an important conversation to have.
So keeping the income in mind, I guess mainly for self-employed individuals, how much income they may or may not be showing on their taxes, to make sure that if a refinance is in the future plans, they can actually qualify for the refinance.
Absolutely. Like not everybody knows what it means to refinance, right? They might be a
Yeah.
first-time home buyer. They may think it's maybe a no-doc loan or something, and we have those out there. There's certain government loans like VA and FHA and even USDA that don't require income verification. But conventional loans, jumbo loans, they require the client to go through essentially the same process that they did when they bought the home. So just kind of having that conversation, making sure they're prepped and ready for that, and doing our fiduciary responsibility to coach people is
Yeah.
critical because the savings is real. Somebody drops their interest rate a point on a refi, that could be hundreds and thousands of dollars a year in interest saved. So let's set people up to win, and it's just
Yeah.
easy as having a conversation about it.
Yeah. Um, and so I know everybody's situation is a little bit different too, but generally at what time frames are you seeing it make sense for a refi? And then how significant of a rate drop do you think it usually makes sense?
That's an awesome question. I have a lot of clients that have reached out to me asking to refinance, and I'll never do a deal just to do a deal, right? The numbers matter, and the thing that we have to evaluate as a lender is what is the break-even point? So there's closing costs associated with the refinance. How long does it take you to recoup the closing costs? And then does this strategy make sense given where the market's at? There's certain loans like I mentioned the FHA, VA, USDA loans. Those are our government loans. They have a streamlined refinance program, which makes it incredibly easy. Lender fees are typically waived. There's no appraisal, no income verification. That's a home run for a client. And I'm typically looking for like a 1 point reduction. When you hit 1 point, that is typically kind of the home run when it comes to refinancing. Now, depending upon the size of the loan, maybe if it's 3/4, maybe even 0.5%. Let's say you got $1 million plus, loan amount. 0.5% could be a significant amount of savings. Everybody's situation's a little bit different, but generally speaking, I'm looking for 1 point to kind of really justify the expenses associated with refinancing. And another strategy I talk with folks about too is like, while we might be able to drop the rate a point, what would it look like if we only dropped 3/4 of a point and use the yield spread to maybe cover some closing costs? So I'm a big fan of having the bank pay fees, and if we can use the rate to kind of take that to our advantage, that's a home run. So different scenarios, different programs have different parameters, but in general, once you're seeing a point reduction, you should be having a conversation with your lender.
And what is the yield spread?
Yeah, it's a good question. I'm using some mortgage jargon here, but yeah, yield spread is basically in every coupon, right? So, and typically you're looking at eighths of a percent, right? So 7 1/8, 7, 6.875, et cetera. So within the different coupons, there's different premium pricing that a lender can offer. So let's say, for example, the lowest rate with no fees or costs associated with that rate, and that would be points, would be 6.5 today, just being hypothetical.
Okay.
At 6 3/4, there might be, and I'm just using hypothetical numbers, $2,500 in lender credit that we could offer that client to offset their closing costs.
Okay.
So generally, as you go higher in the rate stack, depending upon what the par rate that day is, we can actually give a client lender credit back to offset closing costs and fees. And that would essentially be the yield spread that we're talking about.
Okay. That makes a lot of sense.
For sure. Good question.
So I also wanted to talk about first-time home buyers. Especially in our market, it seems like it might be a little bit tougher for first-time home buyers to get in the game of real estate. Places like Flagstaff and Sedona have a higher average priced home. So, let's just start with what do you see as like the biggest misunderstandings that first-time home buyers have around financing?
That's a great question. You're absolutely right. First-time home buyers in these markets, Sedona, Flagstaff, they face a challenge because the average median home price is incredibly high compared to the rest of the state. And I think one of the misconceptions I'm seeing constantly, and I don't know where this came from, but I get a lot of first-time home buyers saying I need 20% for a down payment. That is not a thing. In fact, zero down is a thing for first-time home buyers. There's obviously certain parameters that someone has to meet to get zero down, but even a 3% or 5% down payment, minimum down payment can get you an amazing deal. So I think for first-time home buyers, if the down payment is a barrier for you thinking of buying a house, we have ways to address that. So don't let the down payment be something that stops you. What we do have to have is a very honest conversation with first-time home buyers in these markets that the price point for entry is significantly higher than other parts of the state. And so we've got to have really realistic goals and budgets for them on what we can afford. So maybe that's a condo, maybe that's a townhome, and maybe that's what gets them in to the market. Maybe it's location, right? If you're in town, you're going to have a more expensive home. Maybe we start looking on more fringe neighborhoods or fringe communities to, again, get into the game. I believe in building wealth through real estate. First-time home buyers getting into the market, buying their first home, it's transformative in terms of the wealth that it can create, but we have to coach people and really give them a great roadmap on how to qualify. I think you actually just referred a client recently who's got all the right steps. They've got the job, the income, they've got all the things that they're doing right, but they're just out of range for what they're looking for. But for that client, rather than just ignoring them and telling them they don't qualify, we're going to give them a roadmap on what that looks like, because we don't know what could change in their life. Could they get a raise? Maybe they get married and they've got another, spouse in the house who can support and contribute to that mortgage payment. If we give people the information they need to make a better decision, we can help guide them to how to buy that first house. And everybody's timeline's different. You got somebody coming out of school and maybe they got a professional degree and they're buying that house right out of college. Maybe they need to build up some time and kind of work their way up in their career to kind of be able to afford that home. This is all stuff that we can kind of game plan and forecast out for people.
Yeah, I hear it all the time still, like you need 20% down, you need 20% down. And I have no idea where this myth comes from, because every time I hear it, I tell people, you can do as low as 0. And even on conventional, it's 3% is the
3%
minimum.
down, yeah.
FHA 3.5.
3.5.
It's crazy. And I get a lot of first-time home buyers that think they need to buy the dream home too. They're like, I need to save up $100,000. I got to get the $800,000 house, and that's when I'm ready to buy, and it's going to be in 20 years. And I'm just stacking cash until then. But I think what people don't realize is the opportunities that open up when you just maybe bite the bullet a little bit and wait on the dream house and just get in the game. We also recently just had a client. He bought a piece of land for dirt cheap like 4 years ago. We just sold it for more money than he bought it for. He rolled that money into a down payment and they just bought a condo. Entry level, pricing, housing for Flagstaff. But what happens when 5 years from now that condo is worth more and they can sell that and use that as another down payment or roll that cash over into the $600,000?
Or keep it as an investment, right?
Keep it as an investment. And, if we're going to talk about investments, what does that look like if, let's say they move out of that condo and they try to rent it? Can they use that income from the rental? Let's say they make a little bit of cash on top of it. Can they use that to qualify for a mortgage too?
That's an awesome question. I have had more clients than I can count buy their first home, life changes, maybe they have a couple kids, get married, whatever it may be. They've grown out of that starter home, they rent out that property, and then they buy their next home. And that's a way to stack and build a real estate portfolio, acquiring investment properties, putting minimum down, owner-occupied interest rates, and being able to build passive income through real estate, buying investment properties that were originally an owner-occupied home. So you're absolutely right. That income from the rental, if they're cash flowing, we can use that to qualify in their next home. It's going to have to be on the tax returns. We're going to have a conversation about how to claim that income appropriately, but that's a way to offset the mortgage so that it's not hitting their debt to income ratio when they go to buy their next home. So that's an awesome question, and I think that's something that first-time home buyers should really think about is maybe they don't get the dream home on the first one, right? But it's a way to get into the game, begin building wealth through real estate, because the alternative is maybe that client ends up renting for 4 or 5 years while they save up the money for their down payment or their dream home. That's a lot of sunken costs in rentals, which could have been, again, used to build equity in a home that they own. And the other thing that people don't talk enough about is the tax advantages of owning. Over that 5-year stretch, the renter has no tax deduction for the income that they paid for their housing, whereas the homeowner is able to write that income off on their taxes, and that's a tax deduction that puts tax refund dollars in their pocket. So it's kind of a double win. You're gaining appreciation, you're getting tax write-offs, and again, the passive income that somebody that's buying real estate and renting it out in the future is another way to, again, build your income going forward. So a lot of ways to use real estate to your advantage, and there's multiple avenues. But I love the idea of kind of educating folks that you don't need 20% down. 20% down is ideal for that client who's trying to avoid mortgage insurance.
Yeah.
Right? And that's where the 20% down can become powerful for somebody. Is it's going to ultimately impact the monthly payment because you're not going to have MI on the loan. But over time, what you can find is that somebody that puts 5 or 10% down, even with normal appreciation, let's call it 2 to 3% a year, they will have an opportunity to remove mortgage insurance naturally through the equity they've built and the appreciation in their home. So it's not as though mortgage insurance is on this loan for the life of the loan. There's ways to get rid of that without having to put a significant down payment right off the rip. So great question, and definitely something that comes up all the time.
Makes a lot of sense. And, I'm sure you do too, but that's just what I try to tell my first-time home buyers. The earlier we can start the search, the better to get that financing nailed down and set that roadmap. So people can get their credit score, their income, their savings to where they need to be to get to that entry-level pricing. And then we need to be thinking about 10 years from now, not just what I'm buying today. What's the investment look like? And then, something I hear all the time from the people that waited too long is, oh, I should have bought 10 years ago. All the people that bought in Flagstaff 10 years ago before 2020, and now the now the $300,000 house is worth $800,000. That's life-changing wealth,
Yes.
and that's just the power of real estate. But they got in the game.
Exactly. And I think that's the message that we have to tell folks is like, while it may be scary to commit to a 30-year mortgage or, buy a $300,000, $400,000, $500,000 home, these are big numbers.
Yeah.
What we have to remember is that real estate, over time, if you look at a map or a chart over the last 100 years, generally speaking, real estate has gone up. Now, there's going to be peaks and valleys. There's going to be moments where values dip and values rise. But over the long run, real estate is like any other investment: stocks, bonds, precious metals. There's all these different ways to invest your money.
Yeah.
This is a very powerful tool that when you look at the balance sheet of homeowners versus renters, those that own homes have 40% more net worth than renters. And that's because,
40.
yeah, I mean, these are big, big numbers. And this is life-changing generational wealth that we're helping build for people. And so I think the message has to be, while it can be scary to jump into the game, once we go through the work and we've dialed in financing and we found the right home that fits the budget, we can make this work for people. And we don't want to set folks up for failure. Like, I have very candid conversations with people all the time that maybe this specific home they found doesn't fit the budget, right? Not every deal makes sense.
No.
But if you're swinging a rent payment and you've been doing that for 3-4 years, and we find a home that is kind of in line with what you're paying in rent, maybe it's a little bit more, but kind of in line, and we feel good about your reserves, we feel good about the trajectory of your career, and you're feeling like you're in a good spot, let's jump in. Let's get you starting to build wealth through real estate. But we're not going to just do a deal just to do a deal. We want to make sure that everybody's scenario is kind of tightened up, and we've had a candid discussion about what the implications are.
Definitely. I want to jump over to the other side of the spectrum too. Jumbo loans. People purchasing luxury properties, $1 million plus properties. But real quick before we do that, if you're a first-time home buyer out there, don't be afraid to reach out to a real estate professional or a mortgage professional. Have these conversations early. The earlier you can have these conversations and start thinking about these things, the clearer that path to homeownership gets, even if you're not ready right now. You're not wasting anyone's time. If somebody tells you you're wasting their time because you're a year out, that's not the professional for you.
I'd agree.
So jumbo loans, what about for high net worth individuals?
That's a great question. So I think sometimes we have this misconception that somebody that's buying a more expensive home, a jumbo loan or a luxury property, they've got all the answers, right?
Yeah.
The reality is the mortgage process can be clunky. And when you start exceeding the conforming loan limit and you get into the jumbo category, underwriting has a more kind of in-depth review of that borrower's financials. And I'll be honest, it can sometimes be frustrating, right? We're going to look at things like reserves, and we're going to look at trade lines on the credit report. And depending upon the loan amount, we might need 2 appraisals, right? These are all nuances that, again, the everyday consumer doesn't understand. I always set the right expectation with a client that's looking to buy a luxury property and is doing a jumbo loan, that the underwriting is going to be a little more thorough. We're going to ask for more documents. And for that client, the way I prep them for that experience is by doing more of the work before they get under contract. When somebody gets under contract on a luxury property, you got multiple inspections going on. There's a lot of tension going in there because maybe there's earnest money that's gone hard. There's more money at stake. Just naturally, because the deal is bigger, the emotions feel bigger. And so the last thing I want to do is put somebody through the ringer on the financing when they're dealing with title, when they're dealing with contracts, when they're dealing with all these other, elements. The same applies to somebody that's buying a non-jumbo luxury home. But again, we've got to set the right expectation on those types of loans that there's going to be some additional work. Now, there are programs for jumbo financing if you are, for example, like a W-2 employee, where we can do what's called an AUS jumbo, a little bit cleaner, a little bit less invasive. Maybe the rate's a little bit higher, but it's a smoother process. But all in all, that jumbo investor, that jumbo client who's doing a luxury property, we need to go a little bit more in depth, and it's all about just setting the proper expectations. And then ultimately, working with somebody like myself who's a broker, when you have access to multiple banks, we know which banks kind of value that specific type of loan. And when you're dealing with bigger numbers, the interest rate matters more than ever, right?
Yeah.
0.25%, 0.1%, the numbers get bigger, the savings get bigger when you're able to shop and find a more competitive rate for that type of deal. But great question. And again, in these markets, you're going to see jumbo loans more frequently than somebody that's, not buying in luxury markets like Sedona and Flagstaff.
So on the topic of high net worth individuals too, outside of jumbo loans, what about DSCR loans too? Using things like a bank statement loan or qualifying a property off income if it's an investment.
That's a great question. There are programs out there that understand the real estate investor. So you started talking about bank statement loans. That can be used for a primary residence, but it can also be used for investment. And basically what the premise is for that program is that we understand that self-employed entrepreneurs oftentimes do not claim all of their income from the business on the tax return. Yeah. It's this interesting dynamic between lenders and accountants, right? Accountants, their role is to obviously shield you from tax liability. And they're looking for all of the advantages and tax deductions that self-employed entrepreneurs can leverage to limit their tax liability.
Yeah.
And on the lending side, our goal is to look at income after expenses to qualify. And if we've written all that income off, we may not have enough income to qualify. Yeah. So there's this kind of, paradox here of like writing off income to limit tax liability, but also showing enough income to qualify. And programs like bank statement loans are really effective tools for that type of client who might have written off all their income, because the bank statements might show a truer picture of what the business's actual financials are. And so we do this thing called the self-employed questionnaire. We get to know the business owner. What are the expenses that could be expected for that business? So do you have brick and mortar? Do you have a lot of employees? Or are you a one-man or one-woman show, right? Depending upon the nature of the business, we can develop an expense factor that we think is appropriate for that client. And then we can use that to basically use that expense factor on the deposits in the bank account. So let's say you've got $100,000 a month flowing through your monthly bank statement each month. And let's say you have a 25% expense factor that we've determined based upon the self-employed questionnaire. That means I'm going to use $75,000 a month in income for that client to qualify for a home. Mm-hmm. And these are real scenarios, right? I've got a client who runs a construction business, and we were able to do a bank statement loan and use upwards of $70,000 a month in income when her adjusted gross income on her tax return showed negative, right? So these are really powerful tools, again, and outside the box programs that can help people. The other program that you talked about, DSCR, so that's geared more towards just investment properties. Okay. And there are investors out there and banks out there that understand that the real estate investors' tax returns are probably a little hairy, right? They're doing deals, they're writing off income, they've got all sorts of stuff going on, and the tax returns can oftentimes be a huge barrier for an investor to buy a property because they don't want to go through the exercise of getting a loan. And so these investors have basically said, if you can put down a certain amount of money, and the conversation starts with 20, it gets better with 25 and oftentimes 30% down, but if you can put a healthy down payment, and we can determine what the maybe long-term rents for that property are, or maybe short-term rental if you're doing Airbnb. We can develop what's called a debt service coverage ratio and give you a loan based upon the property's ability to carry its own expense, the mortgage in this case. And what we're typically looking for is a 1-to-1 ratio. So let's say the mortgage payment's $4,000. Let's say the short-term rental costs or the short-term rental revenue is $4,000. That would be a 1 ratio, and that would allow that loan to basically be carried by the rents. And we're going to do a loan on that without looking at any personal financials for that investor. Really aggressive product, something that we're doing a lot of, and in markets like Sedona and Flagstaff make a ton of sense. We got a lot of short-term rental out here. The rents are more expensive, and that allows us to use these types of tools to help the real estate investor.
We do have a lot of short-term rentals between Flagstaff and Sedona. So you're seeing those a lot, is what it sounds like?
Absolutely. I got a call just the other day from a client who was turned down by a credit union because the tax returns didn't show the full story. This client's buying an $800,000+ home, planning to use it as short-term rental. The property is not being used currently as a short-term rental. So you might wonder, like, how do we develop that? We have this website that we use called AirDNA, and it allows us to pull data from comparable rentals in the area where we have kind of the P&L or the income history on those properties. And we pull this report, and depending upon the investor, we can use like 80% of that income, or we can use 100% of the income, depending upon which client or investor that we're going with. But that report basically gives us the financials that we will use to qualify the client.
Okay.
So really aggressive, and again, an outside the box program for the real estate investor. Not every bank's going to offer that. And so when you're looking at how to kind of save a deal, or maybe somebody's not quite fitting into the box, you got to have these tools at your disposal, because investors don't often know that these programs exist.
With, I think Flagstaff and Sedona generally have higher prices. How often are you seeing that 1-to-1 ratio?
That's a good question. We have to really partner with our real estate, team members on how we expect this property to perform on either a short-term rental or a long-term rent. And so long-term rents can have a little bit more of a favorable interest rate. And if that's the scenario that we're going with long-term rents, I'll typically ask, someone like yourself to pull rental comps in that area ahead of time so that we can find out what the average rent is in that area. And ultimately what that's going to do is determine how much down payment we need. So if we're not cash flowing at 20%, that's where we'll talk about maybe putting an extra 5 or 10% down to bring that loan down, bring that monthly payment down so we can start cash flowing. And we don't necessarily need to be 1-to-1. If you're at a 1, the rate typically is more favorable. But if we're at a 0.85, right? So maybe we're not fully cash flowing, we can still do that deal. It's just going to be a hit to the rate.
Yeah, and I think that's why it's so important when you're working in these smaller markets, these hotter markets, especially with vacation rentals. You work with, say, a local lender or a local realtor, so that you work with someone who knows what these properties are probably going to do if you rent them long-term or short-term. And, we can either adjust that down payment, or we could try to find the deal. Maybe we can adjust that purchase price and negotiate with the sellers to get it to a place to where we do get that cash flow, or that 1-to-1.
Yeah, you hit the nail on the head. Like, you got to work with somebody local in these markets, especially a place like Flagstaff, right? You can have a neighborhood that butts up against to a manufactured home park, right? I mean, Munns Park is a perfect example, right? Depending upon where you are in that area can be a huge swing in what your rental costs are or appreciation in the home. The local agent, the local lender, they're going to understand these nuances. And that's going to help you win if you're an investor or a first-time home buyer making the right decision on the house.
I love it.
Yeah.
Well, I think, dude, first of all, thanks, Lewis. That's a lot of knowledge you just shared. And in summary, and if I think there's one thing that anybody who's watching this or sees this can take from it, it's that when you work with a professional and someone in a local market, a local lender, a local realtor, we're here to problem solve, and we both have a lot of tools in our tool belt to put deals together. Whether you're a first-time home buyer and we need to build a roadmap to get you to a place where we can get you the financing, or if you're an investor looking for a rental property, crunching the numbers to make sure they fit for a loan if you need financing, and to make sure that that property's cash flowing, or even if you're just using a jumbo loan to buy a luxury property. You know, it's so important to know that we have all these tools out here to put deals together.
Absolutely, man. I appreciate you having me here. I mean, the setting, the vibe is
Dude, the
really
vibe is
strong right here.
unbeatable.
I mean, I'm looking at the Red Rocks right now.
Dude, I think it's the vortex.
It is. I'm feeling it right now.
I'm feeling the vortex.
But I've appreciated working with you, Hunter. We've been able to close a few deals this year, and just seeing your kind of, growth and progression in this business, like, it's legit, and I'm very proud of you. And I agree, working with professionals like Hunter matter. I would say I'm a professional. I've been in the business 13 years. I'm full-time in this thing. Like, I live, breathe financing. Like, I geek out on this stuff. And, I've seen over the years helping hundreds and hundreds of clients buy homes. I've seen every scenario out there, and I pride myself on being somebody that thinks outside the box, that's creative. I know you do the same for your clients, right? Like, this listing wasn't expired, right? You picked up the phone and brought value, and you were able to do something that another agent wasn't able to do because you put in the work. And I think whoever you're working with, there's amazing lenders out there, there's awesome realtors out there. You need to align yourself with somebody that takes this seriously and is willing to put in the work for you. Because like you said, I mean, whether it's your first time home or you're a luxury buyer, these are serious numbers that we're talking about. These are serious investments, and you have to hit it 100% of the time and make sure that you're getting the best deal for your scenario. And that's where the professionals step in, like us, to make sure that you're getting all of the information you need to make the right decision. I never grip the bat too tightly as a lender. I'm not out here desperate to do a deal. I'm out here to educate people and make sure they know their options and use that information to make the right decision for them. And I know you do the same thing for your clients, and they appreciate that about you.
I can say too that I've never met a lender that has gone as far as you do to educate before going for the deal. You never go for the deal. You just educate.
Absolutely. I mean, that's what we're here to do. And
Moose
again,
calls me at midnight too.
I try not to blow you up too late, man. I know you're trying to have some time with your family, but sometimes deals happen at midnight. You never know.
Sometimes.
Nights and weekends, man. That's when things happen.
Thanks, brother.
Appreciate you, my guy. Rocked it.